Ho, ho, ho. Merry Christmas. Lock in your yield at public.com. It is the reason for the season. You can lock in 6% or higher with a bond account at public.com. The Federal Reserve is probably going to cut this month. Maybe they'll cut next year. Maybe they'll cut as many as 3 times, which means you will earn less on your cash. Public has a solution. It's bonds, corporate bonds, treasury bonds. You can learn a lot about it by going to public.com/compound. This has been brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account to learn more. All right. Welcome to an all-new edition of What Did We Learn? I'm your host, Josh Brown, and I'm here with DataTrek Research's Nick Colas. Nick is a co-founder of DataTrek, which is a newsletter. The morning briefing newsletter goes out to over 1,000 institutional and retail investors, and you guys are at it 5 days a week. Pretty remarkable. Okay. I would say that we're coming into the end of 2024. We've all learned a lot of lessons, and today's show seems like it's really going to be about these are the biggest things that happened this year, and here are really the takeaways that you want to remember going into next year and all subsequent years. And I love doing shows like this toward the end of the year, especially when so many unexpected things took place. I would say that 2025, while it's a quote-unquote normal year in the market, for a lot of reasons, it's a year to remember forever, just in terms of things that they're hard to picture before they happen. And then they happen and everyone says, oh, here's the explanation for why this happened. This is one of those years. Would you agree with that, Nick?
Yeah, totally. It feels like in some ways it is the coda on a very long piece of music where we say, aha, I got it now.
Right. Yeah. I want to start off with 10-year yields and their effect on the stock market, because right at the top of the list of unexpected things, a lot of people have this assumption that rising rates are probably good because they mean the economy is growing, but they'll be negative for stock prices because they could depress the multiple that people are willing to pay on the earnings of stocks. And there are all these like narratives that people have pulled from the history books or the latest macro research they've read. This year seems like there's like very little rhyme or reason, but maybe you have a different takeaway than I do. Tell us about the effect of rates this year.
Sure. Let's put up that first chart, which shows 10-year yields. And I've broken this down by quarter, and I've overlaid the yields, which are in the blue line, with how the S&P did, and how Russell did, and how the rest of the world did, basically the ACWX ETF.
I love this chart.
What were the price returns by quarter? So Q1, rates go up. The S&P rallies 10%, Russell, rest of world's up 5%. Okay, rates are going up. People are a little bit nervous, so they crowd into large caps and you have a big tech move. Second quarter's where things get a little bit weird because rates stay high in Q2 and the S&P still rallies up 4% and Russell, rest of world's down -4, -1. So market's saying, okay, I want to stay in large cap because I'm not sure where rates are going to go. Then you get a big relief in Q3. Rates finally come down. Cool. So finally, the Russell outperforms, rest of world outperforms. They're up 9-8% on the quarter. S&P's only up 6%. So the risk on trade is back. But then we get this big rip in rates in Q4. And you see that the S&P continues to work. The Russell continues to work, up 5% each. Rest of world down 4.5%, and basically flat ex currency. And that's how you end up with a year where you have this crazy return on the S&P, up 27% year to date. The Russell's doing okay, up 16%. Rest of world's only up 7%. And my takeaway from that data and that chart is that rest of world's kind of the stub equity of global equity markets, where the market looks at the rest of world as you need lower rates and a real pat on the back in terms of hoping for global economic growth before rest of world stocks can really work. And otherwise, they just get left in the shadows.
Yeah, but there seems to be like a randomness to this, or maybe I'm not fully understanding. Can we put the chart up one more time? I want to ask you, So the big takeaway here is that the S&P 500 worked in all 4 quarters, whether rates were rising, holding high, falling, or again, rising. This was just like the consensus, no-brainer trade, almost to the point where you could say, don't worry about rates at all, just buy large caps, was the consensus mentality. Do I have that right?
It was, but then look at Q3. The only quarter
Okay.
where rates go down and everything else works better. Rest of world outperforms, Russell outperforms, and it tells you that rates are the determining factor in how global equity investors think about where to put their money. If you're uncertain because rates are going up or rates are very high, you just buy into US large caps. Rates are coming down, you say, aha, that gives me some confidence that global growth will be okay. Otherwise, you're in large caps. And that's what the message of the chart is. And in terms of next year, if you think rates are coming down next year, if you think 10 years are going to go back down below 4 and stay there, then rest of world might be an okay trade. Otherwise, you got to be super careful, because what this chart says is they're not going to work. They're not going to work anywhere near as well as US large caps, even small caps.
Rest of world and small caps are more correlated than rest of world and large caps. Is that also an accurate way to frame it?
It has been this year, yeah.
Yeah, and probably because they share that driver of are rates going down or not.
Yes. Now, small caps were able to break away from rest of world in Q4 because we have the Trump trade going on. Perfectly fair explanation. And rest of world also gets hurt with the Trump trade, so that also makes sense. I mean, to me, the real issue with Q4 has been the tremendous strength in the dollar, and just kills non-U.S. equity returns for U.S. shareholders. If you own ACWX or IEUR or EFA or even anything, if you're in a currency other than the dollar, you got crushed this quarter.
Yeah. Staying on the rates thing, one more question for you. Does the fact that our index is now dominated by rate-insensitive companies that are in traditionally rate-insensitive industries account for why the year went the way it did? You think that's like a really simple way of thinking about it?
It is. And I mean, the other fascinating thing about this year has been we've had rates that are just structurally high, right? The 10-year just has a magnet around 4%. It can't go down much more. And if it does, it goes back up. Rates in 2019 were like 2%. And the valuation on the S&P has gone from 19 to 22 times. So again, to your point, if you're looking at discounting cash flows, you have the discount rate and the growth rate. And the growth rate has ended up being the winner in this trade over the last 5 years. The growth rate of companies that are insensitive to rates and sensitive to economic growth has been overwhelmingly the powerful factor that drives valuations higher, and discount rates matter much less.
Your second point here is that U.S. stocks can keep outperforming even after having been outstanding long-term winners.
Yes.
What's the message here?
So first table shows you just the change in weights for the U.S. versus rest of world stocks and the global equity index. And over the last 10 years, the U.S. has gained 14 points of market share. 10 years ago, U.S. stocks were half of the global equity market. Now they're 2/3.
Look at this.
Gained 14 points. And then what I do is list below all the countries that have lost share, meaning they've underperformed the U.S. And it's all of them except for China and Taiwan. They've kind of held their share. So they performed largely in line with the U.S. market. But Japan down 2 points of weighting, UK down 3, Switzerland off 1.5. The list just goes on and on. They're all negative. Every other country has lost share to the U.S. Every other country's underperformed over the last 10 years.
Nick, I want to keep this chart up and this table up and just really put a fine point on the message here. This is not an index committee somewhere in an office building in New York saying, let's take Japanese equities down 2.4%. This is the collective buying and selling of institutions and regular investors all over the world. What we're looking at is the sum total of their decision making. This is not something that's been like orchestrated or constructed by an index company. Like, this is what people have decided stocks are worth, would be the way to say that.
It's a combination of things. Primarily, it's what you describe. It's the market saying the U.S. is a better place for capital and generates better returns than the rest of the world. And so we're going to give those stocks a higher valuation than the stocks in other parts. The other part, a little bit, is IPOs. There's been, some IPOs over the last 10 years. And to the degree they end up in the U.S. equity market versus another market, that also lifts the weighting. And that you see the combination of those two factors. I'd say it's 80% just raw performance and 20% capital wanting to list, wanting to be held in the U.S. equity market versus rest of world. But it is dramatic to me that the U.S. has just taken share from every other country in the world, ex-China and Taiwan, and it's a persistent, pervasive trend. And the question becomes, does the U.S. go to 70% in the next 5 years? Does it go to 75? Does it go to 80? At what point does the rest of the world's equity market just not matter anymore?
There's a tendency in our industry to look for mean reversion, because I think people like the way people's minds work. They like when things add up to an equation. So they like, if you add this and you take out this is the answer. And they want to believe also that there's some cyclicality to everything, and that sometimes something's riding high and then it's low and then it's back high again. I think people like that kind of sing-songy, this rhymes with that, and you don't always get it. And there's really no mean reversion for international stock market indices by country. It's not like a real thing that exists where if Germany outperforms France for 10 years, France will probably have a better 10 years after. That's obviously not how it works, even though people would love to be able to tell a story where it does. If there is a mean reversion in country or international stock market indices, you may not live long enough to see it. So I think there's this assumption, and there has been for a long time, that if you can just stick it out, we might go through another 10-year period where U.S. large caps underperform the rest of the world, which is the 2000s decade experience.
Yep.
And people that have been justifying global asset allocation, like they really need that to happen. They needed it to start happening 5 years ago, quite frankly. Do you agree that frustration exists out there, and that the catch-up period, it might just be a year here or an 18-month span there? It might not be another 10-year stretch where international gives you that alpha or outperformance. What do you think?
That's certainly been the history of the last 10 years. If you look at the S&P versus ACWX, the MSCI All Country World ex-US Index, there are very brief periods over the last 10 years, call it a matter of weeks, where rest of world stocks can outperform. Unfortunately, they tend to be when nothing's working. So, for example, 2022, they didn't have big tech in rest of world, and so they outperformed the S&P by a couple of hundred basis points because they didn't have that that big
they
tech
fell
implosion.
less.
They fell less. It's not a matter of making more money; it's a matter of losing less money. Which valid trade from a relative standpoint. But I think you have to think, capital markets ultimately measure how well a country performs in terms of getting a good return on capital from its companies. And the U.S. has just done a better job over the last 10 years. Maybe we can put up the next chart, because I think it also fills in some of the gaps as to what the hell's happened here.
Well, so before you explain what's here, chart off for 1 second, John. The part two of this conversation is always, well, you guys have all the big tech stocks. You guys have all the big tech platform monopolies. And that's the reason why. And I think you're about to disprove that.
Yes, in a very vivid fashion. This is what this table shows.
Proceed.
So this table shows you the 1 year, 5 year, and 10-year compounded returns for the S&P 500 large cap sectors: tech, financials, discretionary, healthcare are all there. Communications and real estate weren't around for 10 years, so there's NAs there. And then it compares those 1, 5, and 10-year CAGRs versus MSCI Europe, Japan, emerging markets, all country ex-US, the ACWX. And what I've done here is just code in green and red which sectors outperform over the relevant period the rest of world market index. And it's a sea of green for people who are just listening to this on audio. Every single US sector except for energy has outperformed rest of world over the last 10 years. It's also true over the last 5 years, excluding real estate. Every single S&P sector's outperformed rest of world. And then over the most recent 1 year, healthcare, staples, and energy have underperformed, but every other sector has outperformed. Whether it be on average, they all outperform. And even if you exclude tech, they all outperform every single period. So it isn't just tech. It is an across-the-board judgment that U.S. companies have better returns on capital, better competitive advantage, better earnings growth, and therefore they outperform.
So for the listener, just as an example, let's keep this chart up so I can quote from it. Over the last 5 years, the compound annual return for MSCI Europe is 6.65%. The compound annual return over the last 5 years for Japan is 5.3. For EM, it's 4%. And when you look at each sector of the U.S. Stock market, all of them have done better, with the lone exception of real estate. Again, this is 5 years annual compounded returns. So tech is 23%. Okay, far and away. But financials are 12, and consumer discretionary is 11, and healthcare is 11, and communications is almost 14. So it's remarkable, chart off. It's remarkable the degree to which pretty much every sector of the U.S. economy has had stocks beating up those international averages. And it's, to your point, it's 10 years now of that sort of dominance. If somebody says why, I know you could write a book on the subject, but could you also distill it down to a couple of sentences?
Sure. The single most important thing is the dollar's reserve currency status, because it allows...
That's the most important.
No, well, I'll put it this way. It is the most common pushback against this table. I've shown this table to a lot of people who are bullish, who are bearish, and a lot of we were just in London last week to a lot of European investors, and they say that's great. The issue that they struggle with is, how much is this due to just a better U.S. system of business? And I would argue it's about 80%. 80% of it is the U.S. does a better job at a private company level, a public company level, of managing assets to generate good shareholder returns. There's an intense focus on that in the U.S. market, and it's just cultural to the U.S. It is not the same in Europe, not the same in the rest of the world. However, I would say, in fairness, at least 20% of it is also the dollar's reserve currency status, because it allows a lot of deficit spending. And the bears, and I talk to them as well, will look at this table and say, oh, it's all just deficit spending, and it's all just the dollar's reserve currency status allows us to have a stronger growing economy. And the pushback based on this chart is, okay, then explain to me why every single sector does better on average. And not by a little, by a lot. That can't just be reserve currency status. It has to be endemic to our system.
I think it's cultural. My perspective, I agree on the deficit point, but I think there's a mentality where in America, it doesn't feel as though there are any limits. We don't have this tallest poppy syndrome, where if somebody becomes Jeff Bezos, everybody else wants to jail them or find a way to invalidate what they've built. And we celebrate, for the most part, we celebrate entrepreneurship, and we celebrate the most successful executives within limits, within reason. And then I just think, rule of law obviously makes this a better place to invest capital than a lot of EM countries. You could say the same thing for Europe, but it just doesn't manifest itself in the same way. So it's obviously there are nuances here, but to your point, you can't have every sector for 10 years so drastically outperform everything in these countries and say that it's some sort of a blip. It's just been going on for too long, and it's too pronounced.
Yes, it goes back to that old Larry Summers quote I think we talked about in our prior episode. And he's got this quip, which is cruel but accurate, which is, Europe's a museum, Japan's a nursing home, China's a jail. So where are you going to put your money? And, I always ask clients, okay, well, how would you characterize the U.S.? And the most common answer is the U.S. is a business. And that's what this data shows. The U.S. is a business. We're here to take capital and do something with it. And that's what the numbers show.
Yeah, there's no doubt about it. Okay, we want to talk about top 10 performing S&P 500 sectors, and I think it's really important to point out this was a year where the financials were the leadership group. So every S&P large cap sector is up on the year. Last year, 3 were down. This year, they're all up. But financials were the leaders. What does that tell you? In terms of just this narrative about, it's all tech. It's not. We've had some huge home runs across the market in all different areas.
Yes. And look, we've liked tech most of the year, and it was a dicey trade to recommend even 8 months ago, because it just felt like, how do these things work? And the answer was, first, they were really cheap. As an aggregate group, they were only expensive to energy. They were cheaper than everything else. So they've had a nice
financials.
Financials. And the second thing is, they finally got the repricing, or they're getting the repricing that I thought they would be getting, which is the economy's stable. These are well-run companies. Things are fine. And they've lived through now, a decade plus of stress tests and capital management, and they've come out the other side very strong. And as a result, they deserve a higher PE multiple. I had an old mentor in the business that covered cyclicals. And he said cyclicals always get the PE revaluation in the next cycle. They've got to live through a long period of time in the wilderness. If they do that, they can get a higher multiple in the next cycle. And that's what's finally happening here.
I want to show you my table, and then we'll go to yours. 33% return year to date, and the top 10 S&P 500 financials. You look at some of these names. This is not what a lot of people would have bet to be the biggest winners of the year. KKR is up 87.2% on the year. This is a $136 billion market cap company now. Synchrony Financial, number 2, up 76%. And some of the other names on the list, American Express had an amazing year. Progressive, which is insurance. Discover, which is credit cards. Bank of New York Mellon. Goldman Sachs up 51% on the year. That's a re-rating. Cincinnati Financial Corp is a property and casualty insurance business, up 48%. PayPal up 47%. And Brown & Brown, which is an insurance brokerage, up 47%. Many of those names nobody really talks about on financial television. You don't see people on Reddit getting excited about these stocks. They're not Twitter stocks. But I think that speaks to how undervalued the financials were. Yeah. And then finally having this catalyst this year of rates coming down and deregulation later in the year becoming a secondary catalyst. And that's the formula. Financials are now the second largest sector in the S&P at 13%, trailing only tech, which is 33%. The median return for a stock in the S&P 500 year to date is 13.8%, but it's 29% for financial stocks in the S&P. That's a huge delta. Sean tells me as of this morning, 66% of S&P financials are above their 200-day moving average. It's 65% for the S&P 500. So they're neck and neck with the overall market still, even after all that outperformance. Same median RSI. Financials and S&P are both at about 47. So these stocks are, they're hanging high. They've done really well, and they're staying up. This doesn't seem to be kind of a one and done bank rally, the type of thing that we've seen over the past few years. There seems to be some follow through here. What do you think about that?
Yeah, I think it's fair. And I think it's, in the spirit of, the show, this is a very good sign for next year. How negative can you be on 25 when you've had this massive rally in the financials? And in part because they're getting some respect finally after being in the wilderness for so long.
Let's put up Nick's table of the large cap sectors. What's the message here?
So this is just to speak to how much broader this market has been in 24 versus 23. So you look at the returns from last year by sector, and obviously it was tech and comm services and discretionary, the tech-heavy sectors. 3 sectors were down: staples, utilities, energy, and the rest were kind of meh. And now this year in 24, you've got the best, as we've been talking about, the best performing group is financials. And then you've also got comm services and consumer discretionary, but tech's actually lagging the S&P by a little bit, the large cap sector.
Very interesting.
And there's no negative sectors. To me, the most promising thing about this year is there's no sectors in the red. Everything is up. So it's a very broad-based rally, much healthier. I think we all recall 23 was a big tech rally. 24, big tech has definitely helped, but we have some real cyclical leadership as well. Look at industrials up 21%. How negative can you be for next year if industrials are up 21% on the year?
I think you also wanted to point out that not only is tech underperforming the S&P this year, which I think most people would be surprised to hear, the stocks within big tech have been less important in terms of driving the returns of the market, which is one of the things that you heard the bears saying in 2023, the contribution of big tech. Let's put up this next table.
Yeah, this is a rough breakdown of how much each big tech stock contributes to the S&P in point returns. So, for example, last year, they contributed 20 of the S&P's 24 percentage points of gain, or 83%. This year, it's 68%. There are 18 points of the 26.5% return as of last Friday, and 68%. So they're still important. And obviously, NVIDIA is huge. NVIDIA is 8 points of the S&P this year. It kind of stands alone. Without that, the S&P would have done 8 points worse. But even big tech as a whole, less important. And I think next year, you probably see this number down or below 50% as the rally continues. And as we've seen from this year, other sectors begin to get some respect, like financials.
These are the biggest stocks in the market. It's Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta. So it's Mag 7 writ large. If that were to decline from 68% of whatever market, we're assuming a rally next year. But hypothetically, the bull market continues into next year, and that number goes down from 68% to like 60% or 55%. Where would the slack be picked up from, if you had to guess? Because you need big stocks.
Yeah,
they don't have to be Mag 7. They don't have to be $1 trillion market caps, but they have to be big. It can't really be, like a small cap biotech. Like, it's got to come from somewhere with market cap already.
Yeah, it can't be utilities. It can't be staples. It can't be energy as much as those groups might work. No, it has to come from financials and industrials. That's where it has to come from. The chunky groups that are, 9, 10%, in the case of financials, 13% of the S&P. And the names on that list are like 30% of the S&P.
Yeah.
They're bigger than any sector.
And you got lots of stocks in there too, which is also important. They're not very concentrated in terms of the names. You have a lot of stocks could work out and make up for one giant stock, if it's going to take its place. Do we want to talk about the third year of returns, calendar seasonality, and the NASDAQ?
Let's just skim through that, because I think there's a broad concern that we've had, a pretty strong rally over the last couple of years, and how likely is it that we get a third year? And the short answer is, if you're looking at when the S&P rallies for 2 straight years, and it's up 20% in each year, that's pretty uncommon. It's happened only about 9% of the time. And in the following year, the S&P has continued to rally about 2/3 of the time, and the average return is about 7%. And the bad years are recession years, 1937, 2000, or 1977. And excluding that, the returns can be quite good, 18 to 30%. So the message here is, don't be too worried that the last 2 years have been pretty positive, because the history shows that, as we've talked about so often, price momentum is a super important factor in investing, and price momentum can take the market up for a third year in a row.
I think this is a concern. Like, what right do we have expecting a third annual rally after the incredible 2023 and 2024? I think a lot of people think that way. Again, getting back to, people are always looking for mean reversion. People are, if the roulette wheel keeps hitting black, it's we call it the gambler's fallacy. It's our mind playing tricks on us, giving us this idea that, like, at a certain point it has to go the other way. And of course, we're not just going to have endless annual rallies year after year forever. But a third year is not probabilistically something that is like so completely off the charts that we shouldn't expect it.
No, exactly. And let's not forget, 22 was a pretty horrible year. So on a 3-year rolling basis, we're not all that far from unusual. And you have to take it all you can pick your time frame and tell your story. But ultimately, what's important is earnings continue to grow. The U.S. economy continues to grow. We're exiting Q4 with a very strong economic run rate going into Q1. We've got deregulation to look forward to. We have continued good economy, and that feels all pretty good. And I'll tell you, the thing that I've been thinking a lot about recently is the same is not true in the rest of the world. So the European economy, quite slow. They're going to be facing a lot of challenges with the new administration. Same with China, same with Japan. And so as you think about allocating capital for next year, it's also a matter of, where do you think global equity allocators are going to put their money? And the short answer is, it has to be the US, because nothing else really feels like it's going to work.
I want to ask you about the year 2000 NASDAQ comparison. This is coming up a lot because we just made a new milestone this past week. We hit NASDAQ 20,000. We hit NASDAQ 19,000 in November. These milestones are now coming at us very quickly, which mathematically makes sense, but they also make people think, oh my God, I'm about to allocate capital during the next, year 2000 tech bubble.
Sure.
Now, people have been saying that every year for 15 years, so that's worth pointing out too. But you want to talk a little bit about the comparison and why it's not really a great comparison. And I know we've done this before, but you have a new chart, and I think people should see this. Let's put this up. This is the NASDAQ 1995 to 2000 versus the NASDAQ 2019 to present. And you've indexed the daily returns to 100 for the sake of clarity. Tell us what you see when you look at this chart.
Yeah, so the blue line of the chart shows the 1995 to 2000 dot-com bubble all the way up to the top, and then the first year of the bursting. And then the orange line shows the current environment, the last 5 years. And what you see is that for the first couple of years, things look pretty similar. The NASDAQ doubled in the first half of this sequence, fine. And then things begin to get very different because you had this big rate shock in 2022 that really pulled the rug out from under the tech stocks. And the rally only began to re-engage in 2023, where in the 1990s, after long-term capital blew up in 1998 and tech had a little bit of a problem, after that, the thing just ripped. And on an index basis, the index goes from 200 to over 600. That is the kind of return that you got in the dot-com bubble. From the 5-year beginning point to the peak, you were up 570% on the NASDAQ.
We don't look anything like that now.
And we look nothing like that now. We're just basically, based on the new recent record, we're up about 200%. So the comp is just not accurate from a price return basis. Anybody who thinks this is the 90s wasn't there, because I was there in the 90s, and this feels nothing like it. The 90s were absolutely crazy.
I think if
10
you
IPOs every day, and they all doubled.
Yeah. If you add Bitcoin to the last 5 years NASDAQ, I think you could get close to that chart. You would have to decide on the weighting. But like if you market cap weighted Bitcoin as though it were a sector of NASDAQ stocks, you could get pretty close.
We have tried doing that. We're still mucking around with the numbers to see what the right fit is. But yes, I mean, the Bitcoin, and in dollar terms, the $1 trillion. It's
$4 trillion crypto.
That does feel more accurate as a comp. But maybe we're seeing a new asset class form. Who knows?
Okay, let's get this next chart up, guys. So you're basically showing that the rise that we've seen is much more measured. It's another way of looking at it.
Yes, this is just year-over-year price returns in the NASDAQ going back to the 1990s.
This looks pretty average.
It is pretty average, and this goes back to our old saying, a double is a bubble. The NASDAQ doubled from Feb 99 to Feb 2000, and that's when you knew the top was in. The double is a bubble rule. And we haven't had one since. The closest we got was in 21, pretty close, 80%. So another good warning sign. We're at 35 right now. Doesn't feel like the kind of super extended 1-year returns that you can call a bubble.
So it's a 12-month rolling double is what you'd be looking for to say, okay, this is it. And we haven't had that.
Not even close.
Okay, very important. The last thing we're going to talk about today is the source of American exceptionalism. We did touch on this earlier in the show, but tell us what this table represents, because I found myself staring at the names in the middle section and the bottom section, trying to picture any of these ever being treated the way we treat Apple and NVIDIA, and I just can't get myself there, Nick.
Yes. So again, this calls back to the first point we were discussing, which is what's different about the U.S. market. Why is the U.S. market working so much better? And one way to think about it is just on a pure fundamental basis. And I'm a single stock analyst by background, so ROE, return on equity, is a really critical measure for me. A company's ROE is how well it performs in terms of taking shareholder capital and doing something with it. And the baseline number is like 10%. You got to generate a 10% ROE to call yourself a value creating company. Anything more is great, but 10% is the standard. And what I did was go back and look at the trailing 12-month ROE on the top 5 companies in the S&P, the top 5 companies in the MSCI EFA index, and the top 5 companies in the MSCI Emerging Markets Index. And for the US, it's a strong story. The top 5 companies, Apple, NVIDIA, Microsoft, Amazon, Alphabet, they're 29% of the S&P. They have an average ROE of 62%. This is a fantastic number. The worst number on
Apple's return on equity is 165%. So this is the gold standard for the entire universe.
It is the reason. Look, Apple hasn't grown very much, but Apple has a fantastic shareholder mentality, which is why Buffett owns so much of it.
Or used to.
So, used to, yeah. I mean, he saw a company that basically took every dollar of net income and bought back stock or paid dividends for 10 years in a row.
Yeah.
That's the magic of Apple. That's why the ROE is so huge. But the rest are great. NVIDIA, 6, 7, 8%, Microsoft, 33. Amazon always reinvests, but it's 15. Alphabet, 26. These are solid numbers. So, fine. US checks the box. The top 5 names in the MSCI EFA index, Novo Nordisk, ASML, SAP, Nestle, and AstraZeneca, their weightings are only 8%. Their average ROE is only 39%. So these are very strong ROEs, but on average, they're not as good as the US. And these are top companies. They only have an 8% weighting in MSCI EFA. So now we begin to get, a storyline about why S&P works so well. The companies are just much better, and the S&P owns a lot more of them.
These are high multiple stocks, though, right, Nick?
Yes.
Especially in the countries they're from, they must stand out like a sore thumb.
They absolutely do, and they also stand out because they're relatively rare.
But this is important, right? There aren't many of them, but this is an important point. They're not treated like European stocks by investors. They're treated like high ROE growth companies by investors. And they get multiples the way our large cap growth companies get higher multiples. And I think that that's really the signal that if things were to change in Europe, whether it's from a mentality standpoint or just the way the government is regulating companies, there is the potential for higher multiples in Europe, because this is evidence that global investors will pay up for SAP and ASML and Novo Nordisk, because they look American.
Yes.
Okay. I think that's really like a very positive sign if somebody were to take that idea and really run with it.
Yeah. And the issue is you got to have more of them, because they're only 8% of MSCI EFA.
Yeah.
So you need more of them like that. And then we go to emerging markets, same thing. Top 5 names in MSCI Emerging Markets Index: Taiwan Semi, Tencent, Samsung, Alibaba, HDFC, which is an Indian bank. And there, the ROEs average out to 13%, which is much lower than the US. Now, those names are 21% of the index. They're kind of the same as the 29% in the S&P of the top 5 names, but the ROEs are much lower. Taiwan Semi is strong at 24. Tencent's okay at 14, but Samsung, 4%, Alibaba, 7%. These are very low ROE businesses. And so their valuations are lower. So another sort of fundamental way of thinking about why is the U.S. doing so well. And a big part of it is the companies are better.
Yeah. I wonder why those returns on equity are so much lower even than the European mega caps or large caps. Is there a simple way to understand that?
No, because I was reading all these financials over the weekend, and obviously they are, very different sets of companies.
Yeah.
Novo stands out, and the returns there have been fantastic. ASML the same way. If I had to guess, it was just, it's a little bit of taxation. It's a little bit of shareholder mentality. But look, these are good numbers in Europe. There's not a number on this list for these top 5 companies that anybody should be embarrassed by.
Yeah. If only they had 10x the amount of those types of companies, it would be so if you had to guess over the next 5 years, if this were to converge, does it converge with US ROE falling, or potentially the ROEs of more companies in Europe and the Middle East and the Far East getting better? Which direction do you think that goes, or does it stay the same?
My first assumption is it stays the same, that the gap is relatively constant, because there's no net change. If there's a net change in policy, it's a net change positive in the U.S., possibly to lower taxation and less regulation, which lifts margins and increases growth.
Yeah.
The second thing, but I spend a lot of time worrying about this because, and we travel to, whenever we travel to countries, we try to meet entrepreneurs and try to meet systems that are trying to encourage entrepreneurship. And there are some interesting efforts going on in France, some interesting efforts going on in the UK in biotech research, but there's not enough structural change to make risk-taking acceptable, to make entrepreneurship acceptable, to give companies a real shareholder focus. So I think the gap continues to be about where it is today.
Hence your earlier point, if you're not investing in the US, where are you putting money? And I think that sums it up nicely. I want to let people know, first of all, thank you so much, you and Jessica, for all the outstanding work you've done on this show all year. It's been a pleasure checking in with you guys each month and tackling these topics with you. I want people to know where they can go to get more DataTrek Research. They can go to DataTrekResearch.com, of course. They can also follow your YouTube channel. You are youtube.com/@ Nick Colas and Jessica Rabe. And you guys are pumping out video content on a pretty regular basis at this point. Are you having fun doing it?
Yeah, it's a lot of fun.
All right. And the last thing I want to say is you will be our guest, Michael Batnick, myself, and you will be discussing all of these topics and more on an all-new episode of The Compound and Friends, live in person this Thursday. We haven't seen you in a while. We miss you.
I'll be there.
You ready to rock?
Really? Absolutely.
All right. We have a lot of stuff we want to get to with you as the year wraps up, so couldn't think of a better person to have on the show. So, guys, if you loved hearing from Nick today, get ready for even more at the end of this week. All right, that's it from us. Please make sure you subscribe to the channel. Check out Nick Colas and Jessica's channel. Check out DataTrekResearch.com, and we will see you soon.